Number 9. Historical cost concept or cost principle. The value of an asset is determined on the basis of acquisition cost. A historical cost is a measure of value used in accounting in which the value of an asset on the balance sheet is recorded at its original cost when acquired by the company.
This concept is not always maintained. Some PFRS requires the departure from this concept, such as when inventories are measured at net realizable value (NRV) rather than at cost when applying the lower of cost and NRV measurement.
Concept of articulation. All of the components of a complete set of financial statements are interrelated. The preparation of worksheet and the eventual complication of the financial statement recognize that the financial statements are fundamentally interrelated and interact with each other. Accordingly, when users use the financial statement in making this discussion, they need to use each financial statement in conjunction with the other financial statement. For example, the amount in the one statement as the net income on the income statement in incurred forward to another statement, in the case the retained earning statement.
Receivables and payables. In the statement of financial position, provide information on expected cash receipt and cash disbursement in the future period. Account receivable and account payable are essentially opposites. Accounts payable is the money owes its vendor, while account receivable is the money that is owed to the company, typically by customers. Income and expenses in the statement of profit or loss and other comprehensive income provide information on the entity's ability to generate cash flows from its operation. The income summary account is a temporary account into which all income statement, revenue and expenses accounts are transferred at the end of an accounting period. The net amount transferred into the income summary account equals the net profit or net loss that the business incurred during the period.
Information on historical changes in cash and cash equivalents in the statement of cash flows helps users assess future sources and uses of funds. The notes to financial statement provide information on the quality of earnings, whether income or expenses are realized or unrealized, or whether they are recurring or non-recurring.
Full disclosure principle. The full disclosure principle is the accounting principle that requires an entity to disclose all the necessary information. It is financial statement and other related signification. This is to ensure that the lack of information does not mislead the user of the financial information. The idea behind the full disclosure principle is that management might try not to disclose any information that could impair the entity's financial statement and reputation as whole.
Example of the full disclosure principle. The several example of full disclosure involves the following items. First, the nature and justification of a change in accounting principle. Second, the nature of a monetary transaction. Third is the nature of relationship with related party with which the business has significant transaction volume. And fourth, the amount of encumbered asset. And fifth, the amount of material losses caused by the lower cost or market rule. And sixth, description of any asset impairment obligation. And the last, the fact and the circumstance causing goodwill impairment.
Consistency concept. The financial statements are prepared on the basis of accounting principles that are applied consistently from one period to the next. Changes in accounting policies are made only when required or permitted by the PFRS or when the change results to more relevant, reliable information. Changes in accounting policies are disclosed in the notes.
Consistency concept is a basic principle of accounting, stating that the same methods for doing accounts should be used from one financial year to the next, so that profits, losses, etc. can be compared. According to the consistency concept, once a business has decided on a particular method for treating an accounting item, it will treat all similar items in the same way in the future. Example: if the business entity follows the straight-line method of depreciation and after some time law changes which states that every entity is required to follow the written-down value method of depreciation retrospectively. Now, an entity has to provide depreciation as per written-down value method retrospectively and accordingly charge the depreciation and effect on profit due to change in method of depreciation to be disclosed, and fact that method of depreciation has been changed due to change in law also to be disclosed in the financial statement so that users can understand easily.